If you own a company in Poland and you also invoice or plan to invoice that same company for consulting services or other services, then this video is for you. Poland's tax authorities just closed a wave of audits on business owners doing exactly that. And the bill, over 2 million zloty in back taxes and interest, recovered in the first half of this year alone. Hi, my name is Michał. I am a Polish licensed tax advisor and I provide accounting, cost calculation, tax compliance and tax advisory services for small and medium-sized enterprises in Poland. Today I am walking you through an information published this month on the website of the Polish National Tax Administration. As follows from this information, in the first half of 2026, inspectors from the Warszawa-Wawer tax office ran a targeted audit campaign. During this campaign, they looked at entrepreneurs working in three sectors: consulting, intermediary services, and IT services. And according to the information published on the website, here's the pattern they found. Owners of these companies run their own sole proprietorship, so they were conducting business activity as a natural person. Apart, of course, the fact that they were at the same time shareholders and board members of companies providing consulting, intermediary and IT services. Furthermore, what also follows from the mentioned information on the website of the Polish National Tax Administration is that the business activity carried out by these natural persons, being at the same time shareholders and board members in limited liability companies, these persons were settling their tax from the business activity carried out as a natural person within the tax regime of the so-called lump sum taxation, called in Polish ryczałt od przychodów ewidencjonowanych. And through their business activity carried out as a natural person, they invoiced their companies, probably limited liability companies, for services. It is stated in this information that these mainly were consulting services. All of that sounds ordinary so far. It is not uncommon in Poland to hear that business owners structure their pay this way. But the tax office looked closely at what that consulting actually involved. And in these cases, Polish tax authorities came to the conclusion that the scope of the services matched the duties the person already had as a board member in the company. And here's the part that actually matters. Within personal income tax, lump sum taxation regime, you pick a rate. For consulting and IT work, depending on what the services actually consist of, you may land at the rate of 8.5%, 12%, up to 15%, and you pay that, you apply this rate on what comes in on revenue. You are not allowed to recognize tax deductible cost, but a lower headline rate applies. And that's exactly why it's popular. Also in cases where a shareholder invoices his own company via the business activity carried out by him as a natural person. Because thanks to this solution, you effectively distribute the profit of the company, the limited liability company, for example, to you at these lower rates of 8.5%, 12% or 15%. Whereas in case such profit would be distributed from the company to the shareholder in a classic way via a dividend payment, the effective tax burden would amount from around 26 up to a little bit more than 34%, depending on the applicable corporate income tax rate at the level of the company, where depending on the revenue made by this company, the applicable corporate income tax rate would amount 9 or 19% within the classical model of corporate income taxation. But the problem is that the Polish tax law carves out a separate category for income tied to sitting on a management board. Income derived from this kind of activity falls under the category of revenues from personally performed activities, and income falling under this category cannot be taxed within the lump sum taxation regime. It has to go through the standard personal income tax scale instead, where you pay 12% for income up to 120,000 zloty yearly, with applicable tax-free amount of 30,000 zloty yearly. So consequently, within this first threshold of 120,000 zloty, effectively you pay 9% of personal income tax. But on all income above those 120,000, a higher personal income tax rate is applicable, namely 32%. So consequently, this kind of revenues is taxed at a much higher level than revenues derived from business activity carried out as a natural person, which can be subject to personal income tax within the lump sum personal income tax regime. Of course, under the assumption that the amount of revenues, amount of income is higher than 120,000 zloty yearly. As indicated in the information made available by the Polish National Tax Administration, tax authorities simply reclassified the income declared by these taxable persons as income derived from business activity carried out by a natural person into income derived from personally performed activities subject to scale at 12 and 32%. And as a result of that, they calculated outstanding personal income tax with interest. And although it is not stated in detail what happened and how the Polish tax authorities approached it and classified the whole case, it has to also be considered that such situations may not only have personal income tax consequences, but also VAT consequences. Since the revenue, the income, was reclassified by the Polish tax authorities as revenue income not derived from business activity, usually in such cases, Polish tax authorities may also represent the approach according to which the invoices issued by the natural person to the company are so-called empty invoices. And since according to Polish VAT provisions you are not allowed to deduct input VAT from empty invoices, potentially also the input VAT deduction at the side of the company receiving the invoices may be questioned, and the company may have to repay the VAT deducted from such invoices. Also, interest on late payment would be applicable. Potentially also the so-called additional VAT liability, which in case of input VAT deduction from empty invoices amounts 100%, meaning that on top of the previously deducted input VAT that now has to be paid back to the tax authorities, additionally 100% of this amount has to be paid. And this is still not all, because issuing of empty invoices may have also consequences for the entity issuing such invoices. As well, usually at the end of such tax audits, tax authorities initiate penal fiscal proceedings. So when the tax office found that the consulting invoices were in substance a repackaged version of duties the person already held as a board member, they reclassified the income. And the result for the National Treasury was over 2 million zloty of income. So here is what I think about it and what I would suggest. Personally, exactly because of such information published by the Polish National Tax Administration, I am not a fan of such solutions. My suspicion is that due to the Polish National Electronic Invoicing System, where Polish tax authorities can see what a given invoice is issued for, Polish tax authorities may be able to target such situations much better than in the past. But of course, also in the past they had some instruments which were, in my opinion, weaker to identify owners of companies issuing invoices for consulting services and in general for services to their companies. If you are a rather risk-averse person and you value security, do not implement invoicing of your own company, which of course will come at a higher cost. And if you are willing to take this risk, very well implemented. Beware that there especially is a problem when the whole paperwork says consulting, but the substance is simply doing your job as a board member. Tax officers are also frequently willing to look past how an invoice is labeled and ask what the person actually did. So first, look at every agreement based on which you invoice a company you own or sit on the board of, and ask honestly, does the scope of this consulting work overlap with the duties you already have as board member, or potentially based on some other title based on which you already derive income from this company, like for example an employment agreement. If the answer is yes, that's the exposure this case describes. Secondly, if that income is currently taxed within the lump sum taxation regime, get the classification of the applicable rate reviewed properly. As a third point, gather and keep the documentation that proves this distinction: scope of work, deliverables, hours, anything showing this service is genuinely separate from your board member duties or duties based on other title. That's your evidence if it's ever questioned. And finally, keep in mind that from my point of view, you will not be able to minimize the risk of such structure to nil. There always will be some risk, and the information of the Polish National Tax Administration that is discussed here shows, based on the mentioned identified amounts of outstanding tax, that within the audits, rather smaller companies were targeted. Okay, that's all in this video. Thank you for watching and see you next time.